with that stock market? It's pretty impressive, Jack. Come on. You're pretty impressed.
I pulled up a list yesterday. I just want to see, hey, what are the big performers? What are the top performers this year?
Besides Apple.
Trash. A lot
Waste
of trash.
Management?
No, not that kind of trash.
Oh, garbage. Oh, it's
a lot of lower quality. I'm not going to mention names because now that I've called them trash.
It's higher beta stocks is what they're called.
Yeah, companies that are struggling to make money now. I guess the thing is that late last year we thought, hey, maybe survival is in doubt for some of these companies. Now the economy looks a little bit better, so they've sprung back to life.
It
had high
tends to
percentage
be
gains.
Higher beta. You know, these are the stocks, the small cap, mid cap stocks that the hedge funds and other relatively fast money can get into.
Yeah.
That, you know, it's hard to move a stock like a Microsoft.
Right.
Not so hard to move a $1 billion, $2 billion market cap company that maybe last year was facing bankruptcy.
Exactly. For Microsoft, it's future prosperity wasn't that much in doubt last year. Things haven't changed dramatically. Right. But for some of these retail chains, for example,
retail stocks,
it's a vastly different picture today than it was late last year.
Let's turn to your piece. You wrote about next year, right?
Yeah.
There's assuming nothing happens, and that's a big assumption, right? Because it's still unclear what will happen with tax cuts next year. There'll be a big increase in taxes on dividends for rich people.
Nothing is a big something in this case, because if nothing is done, then some of the tax reductions expired. What will happen is that the top rate, there's a cap on the dividend tax rate right now at 15%, and for top earners, for just the high earners, the maximum rate, it's actually going to go over 40% because you get a top tax bracket of close to 40%. You get some additional taxes related to investment income for the new healthcare overhaul. So more than doubling of the dividend.
Now, this won't happen to capital gains, though. It's just dividends. Is that correct?
It could happen.
We don't know.
It's up in the air at this point. But the fear is this with dividend stocks, right? These have been a big draw. Last year they were great performers. Investors.
So we're talking about like healthcare stocks, energy stocks,
utilities,
telecom stocks that people have run to in search of 4 to 6% dividend yields. Correct?
Right. And if there's a big tax hike, coming for the dividends that these stocks pay, and if the market tends to be forward-looking, then it might not wait around for that to happen. You might see some price declines for these stocks between now and then. So the thrust of my column is what dividend investors can do to protect themselves from that sort of event.
You mentioned some strategies like option strategies or things like that.
Too expensive.
It seemed, that's the problem with uncertainty. You're not sure what you should do.
Yeah, exactly. Trying to hedge risk totally away like that becomes very expensive and defeats the purpose of investing to begin with. But the biggest thing that most dividend investors want to do right now is if you've gone after the high yielders, try to shift some of your focus from the highest yields to payment growth. And you should really do that anyhow, because the evidence says
you could also end up overpaying, like a lot of investors are on the stock market, for the growth. I mean, growth stocks are the ones that have really been on fire this year so far.
Yeah, but I don't mean like the fast-growing companies. I mean the companies with a solid record of growing their dividend payments.
I see.
So in other words, instead of saying to yourself, hey, I want to get 4 or 5% yields right now, say, look, let me take 2% yields, but let me get a company that has a record over the past 10 years of growing its payments by 10 or 15% a year. And those are the companies that tend to do better over long time periods. Anyhow, you sort of put less at risk because you don't have the enormous yields. You put less at risk of investors bailing out of some of these stocks.